There's a broad number of indexes that are pointing to a slowdown that is extending beyond what was considered to be just a temporary slowdown in Q1. It's now definitely moved into Q2. We see it with industrial production. We see it with retail sales. We see it with manufacturing at 9-year lows. Now, at the end of a cycle, at the end of a business cycle, you have very low unemployment, as we do now, for example. We're obviously at 50-year lows in unemployment, which means 99.9% of all unemployment history is really higher, and that has to be kind of generally a concern because things always look great at the end of the cycle, right? And economic data is still good and confidence is still high, but it's the underlying change in growth that has to be concerning, that they're often indicative that a cycle may be about to turn. And of course, we're seeing that right now, one of which is, for example, housing sales, right? The housing prices are dropping significantly year over year. And that's one of those classic correlated economic indicators that suggests that we may be risking a recession coming. And it's not an immediate indicator, but it's certainly right now, if you look at the data in the screen in front of you, that's the third deepest decline in medium home price sales since 1970. And the other two were coinciding with a recession.
You just wonder how much of that is transitory, if any, of course, Sven. It may not be, but with the global trade war going on, because it's not just the United States and China, there's more stuff on the headlines. CNBC viewers, for example, maybe people are just thinking, okay, let's take a step back and see how this plays out. And then if it works out, they get back in. I do wonder if this is a short-term thing or, to your point, maybe more of a longer-term macro negative signal.
And this is the big battle for price control here at the moment. I think you're absolutely right. There's a lot of hesitation. As we see with Brexit in the UK, there's a lot of uncertainty. To the extent there's uncertainty, you hold back with investments and so forth. We see that in the US as well. There's no real indication of increase in capital investments. All the spare cash, if you will, from the company side is put into buybacks. And these things obviously continue to have a bid under the market. And so now we're in this price zone between 2,800 and 2,900 on the S&P. And we got to watch out for it, because the longer this trade war drags on, and as you just showed at the top of your segment, there's no indication it's coming to a close anytime soon. I think there is going to be further pressure on these economic indicators. And maybe it's possible one can trade war oneself into a recession.
What about the equity markets? Obviously, the stats, the Dow, its first 5-week losing streak in 8 years. The NASDAQ, the transports, the S&P, first 3-week losing streaks of the year. However, those indexes are still higher in 2019. Sometimes we've got to remind ourselves of this fact. What do you see going forward?
Well, to your point, we've been down for 4 weeks on the Dow here, and you're seeing some short-term oversold readings. We're getting into the end of May, June time period. There's some positive seasonality associated with it. However, having said that, history also shows if markets turn into the May-June timeframe, there may be significant more downside ahead. One concern I generally have had with markets so far this year is basically twofold. One is that on an equal weight basis, if you look at just the indexes, which are market cap weight based, they look still very high, right? We're still in the 2850 range, if you will. But if you look at it from an equal weight perspective, if you measure everything equally, then all of a sudden you see that 2019, there was a lot of less participation by the broader market. That's one of those big concerns in terms of ending cycles, right? You have the low unemployment, you have the high markets, but you have weakening participation. And so this year, when we made new highs on S&P and NDX, that's exactly what happened. We had a 7% lower read on the equal weight. So now when you look at markets today, you got to recognize that between the highs of January 2018 and now, which is 15 months ago, a lot of the indices are actually lower. The Russell is down 5%, NYSE is down 7%, the banking index is down 17% from these highs. So you still have gains in NASDAQ and S&P basically, but it's very much flat in an overall perspective. So markets haven't gone anywhere, and they need to break out of this range higher. If you can get above 2,900, then maybe you can keep filling those gaps that were left in early May. Drop below 2,800, and specifically below 2070.76, then you're running a risk of going down to 26.40. There's a technical pattern that we're watching that may see that happen.
All
so
right.
we'll have to wait and see. This is now a battle for control.